Hi, welcome to Listen to Riches. Today I'd like to share a summary of the book The Barefoot Investor by Pape. Have you ever wondered why they call him the Barefoot Investor? Well, it's quite simple, really. The name reflects Pape's humble beginnings, growing up in the countryside with his father. Despite later becoming a stockbroker in Melbourne, he never lost touch with his roots. The Barefoot Investor is all about helping you with your personal finances so that you too can look in the mirror and say, "I've got this." A bushfire raged through Pape's town and took everything from his family: their home, their farm, their sheep, and everything they owned. Their life's possessions now amounted to a charred pile of rubble. And just as everything seemed to be falling apart, Scott looked in the mirror and said, "I've got this." The book takes us through different stages of life: plant, grow, and harvest. There are specific actions littered throughout the book and tasks you should complete if you want to truly control your own finances. It's well worth reading and putting into practice. The bucket strategy of managing your money without budgeting is amazing. In his book, Pape breaks down 9 steps to achieving financial freedom in a very easy-to-understand manner. We like it so much that we've decided to give you a quick overview of these steps for an easy-to-follow summary. Without further delay, let us start with the first step: monthly date nights. Schedule regular date nights with your partner, or even for yourself. It's essential. These evenings provide a great opportunity to keep tabs on your financial progress and how well you're following your financial plan. Make these nights enjoyable by discussing your finances over a glass of wine and some delicious food. You could even explore new dining spots each month to keep things exciting. It's a far more pleasant experience than those dreary post-work money conversations at home. Being aware of your financial situation is crucial for everyone, including both partners in a relationship. If one or both of you haven't reached that level of awareness yet, starting with monthly date nights is an excellent way to kickstart those conversations. Begin by examining the fees associated with your everyday bank accounts and your superannuation fund. Ideally, you should be paying 0 fees for your bank account. If you're being charged, it's time to switch to a different bank promptly. You might also want to consider opening a new account, known as the Mojo Bucket, in Pape's terminology. Work towards accumulating $2,000 in this account to create a financial safety net for unexpected expenses. Having this money set aside will significantly reduce the stress of managing your finances. Don't forget to review your superannuation fund as well. Compare the fees and take a look at where your fund is investing your money. If you're unsure about how to approach this aspect, we can provide assistance with superannuation and guide you in the right direction. Additionally, it's a good idea to assess your insurance coverage. Are you adequately insured for your specific needs? If you're uncertain about what's available or necessary for your situation, we can offer assistance in this area as well. Step 2. Set up your Barefoot buckets. The buckets is none other than your bank saving accounts. In these steps, we delve into what Pape calls the serviette strategy. The origin of this name is quite straightforward. Pape aimed to create a financial plan so simple that he could jot it down on the back of a serviette. The concept is refreshingly simple: establish different buckets to allocate your income strategically. While the book provides detailed guidance on setting up these buckets, here's a basic breakdown of how you should distribute your income with each paycheck. 1. Blow bucket 60%. This bucket is designated for your everyday expenses, such as rent or mortgage payments, groceries, phone and internet bills, insurance, and utilities. 2. Fire extinguisher bucket 20%. The fire extinguisher bucket is where you save for significant financial goals, which might include things like a down payment on a house or accelerating your mortgage payoff. It can also be used to tackle outstanding debts. 3. Splurge bucket 10%. The splurge bucket is your source of cash for enjoyable indulgences that make you feel great, such as shopping for new clothes, electronics, household appliances, and enjoying your social life. 4. Smile bucket 10%. Lastly, the smile bucket is reserved for long-term savings goals that bring joy, such as planning a wedding, a dream honeymoon, or an unforgettable vacation. When it comes to choosing the right bank accounts for this strategy, the Barefoot Investor suggests exploring options like 86,400, Australia's pioneering smart bank, ING, UBank, Me Bank, and Up Bank. These financial institutions can help you set up the buckets effectively to manage your finances with ease. Coming to the third step, as advised by the Barefoot Investor, it's time to tackle your debts. Take a moment to jot them down, making sure to note the interest rates for each one. To make debt repayment more manageable, explore whether you can negotiate better terms with your current lender or consider switching to one offering more favorable terms. To kickstart your debt repayment journey, organize your debts in ascending order, from the smallest to the largest. Begin by tackling the smallest debt first. This approach will give you a sense of accomplishment and build momentum towards conquering the larger debts. Scott Pape suggests breaking down your debt into 5 domino blocks, each representing a critical step in your journey. Here's a brief overview of each domino. Domino 1. Calculate. Before devising your debt-crushing strategy, it's crucial to understand the scope of your debt. Start by calculating all your current debts. This can include credit card balances, outstanding fines, or loan payments for items like your car or electronics. Create a list or a spreadsheet on your computer to keep track of these debts. Domino 2. Negotiate. With your first domino in place, it's time for the next step, negotiating better terms for your larger debts. Armed with your statements and phone in hand, the Barefoot Investor recommends calling your bank and haggling for lower interest rates on your credit card balances and loans. Don't be afraid to push hard. If your bank resists, which is likely, inform them that another bank has offered you a more enticing deal, such as no application or transfer fees and a 0% balance transfer for the first 18 months. While they may not match the offer, they may be willing to lower your current rate, as retaining existing customers is cost-effective for banks. Domino 3. Eliminate. This step is all about removing temptation. Take a pair of scissors and cut up all your credit cards. This symbolic act signifies your commitment to breaking free from debt and embarking on a debt-free future. Domino 4. Detonate. Here's where you arrange your debt list from smallest to largest and focus your efforts on clearing the smaller debts first. By conquering these smaller debts, you'll gain a significant boost in confidence and motivation. Start with the smallest debt, which could be something as minor as repaying a $5 coffee debt to a colleague. By beginning with the smallest debt and progressing through your list, you'll generate momentum for tackling the larger ones. Remember, while this approach makes managing your debts more feasible, always meet the minimum monthly payments on all your outstanding debts. Avoiding persistent debt collector calls and letters is key to your journey towards becoming debt-free. Domino 5. Celebrate. The final step is straightforward. Celebrate your victories. When you've paid off your smallest debt, like a loan repayment, take a moment to celebrate. You can mark the occasion by disposing of your final repayment bill, perhaps by setting it alight in the sink or simply tossing it in the bin. Every win, no matter how small, deserves recognition. Celebrating your progress is essential for maintaining momentum and staying committed to eliminating all your debts. Keep pushing forward, focusing on the next debt, lining up those dominoes, and knocking them down. Each domino you topple will empower you to regain control of your financial situation. Step 4. Buy your home. Scott Pape firmly believes that despite the prevailing culture of indulgent brunches with smashed avocado and $4 coffees, owning your own home is still an attainable goal in today's real estate market. What's more, he asserts that you can achieve this milestone in just 20 months. But before we dive into the strategies for achieving this, let's take a moment to examine the common mistakes people make when striving to buy a house. 1. Waiting for a housing market crash. It's unwise to base your life plans on unpredictable market fluctuations. 2. Purchasing a home beyond their financial means, overextending oneself financially can lead to significant stress and financial instability. 3. Prioritizing an investment property before their primary residence. While investment properties have their merits, they shouldn't overshadow the importance of owning the place you call home. 4. Renting without saving. Renting can make sense for some, but it's crucial not to neglect saving while doing so. 5. Failing to explore alternative housing options. Consider options like urban apartments or rural living, which might offer more affordability. Now, take a moment to reflect. Are any of these pitfalls sounding familiar to you? Now, onto the most challenging aspect: how to save for that all-important down payment. If you recall from Step 2, we discussed the concept of the fire extinguisher bucket. It's time to tap into those funds. According to Pape, you should aim for a 20% deposit for your home. This not only demonstrates your ability to save but also helps you avoid the costly burden of lender's mortgage insurance, LMI, which can drain your finances over the life of your loan. Scott Pape then offers advice on how to expedite your deposit savings. The average Australian earns a net income of $5,000 per month. A couple who can adapt to living on one salary for 20 months could potentially save around $100,000. However, it's important to acknowledge that everyone's circumstances vary. Avoid setting unrealistic savings targets that can't be sustained over the long term. Realism is the key to achieving the best results. Here's a pro tip: borrow less than the maximum amount the bank is willing to lend you, and ensure that your monthly repayments don't exceed 30% of your take-home pay. This prudent approach will help you manage your financial commitments responsibly and avoid undue strain on your finances. In the 5th step, Scott Pape delves into the question of whether investing in property is the right choice for you. We highly recommend picking up his book to explore the detailed pros and cons of this decision. Now, let's talk about a word that often sparks dreams of financial abundance: millionaire. Wouldn't it be wonderful? Pape suggests that a significant step toward realizing this dream is to boost your superannuation contributions to 15% each year. Given that your employer is already contributing 9.5%, all you need to do is increase it by 5.5%. This not only leads to valuable tax savings, feel free to consult with us for more details on this, but it also sets you on the path to a more comfortable retirement lifestyle. Here's a compelling example Pape provides. Consider a person at the age of 30, earning $72,000 annually, with $50,000 already tucked away in their superannuation. If they automate their super contributions and allocate a total of 15% of their salary, that's an additional $330 per month flowing into their super fund. Fast forward to the age of 67, assuming an 8% growth rate and 2% inflation, they'll have a whopping $569,073 more in their super fund compared to if they hadn't added that extra 5.5%. By the time they retire, they would be well on their way to accumulating $2,063,179. It's an opportunity that's hard to pass up. Step number 6. Boost your mojo to 3 months. Revisiting Step 1, we discussed the mojo bucket and the importance of depositing $2,000 into this designated account. If you've diligently followed all the steps thus far, you've made significant progress in building your savings towards that all-important house deposit. Now, in Step 6, Scott Pape advises you to work towards accumulating 3 months' worth of mojo money, which translates to a solid $6,000 securely tucked away. Achieving this milestone, in combination with successfully completing the other 5 steps, will put you well on the path to banishing that dreaded "I'm worried about money" feeling from your life. It's worth noting that research has demonstrated a direct connection between having savings and experiencing happiness, a correlation we wholeheartedly endorse. As always, we're here to offer our guidance and support should you require assistance with any of the steps outlined above. Striving for financial freedom remains the ultimate objective for all our valued clients. Step 7. Get the banker off your back. Scott Pape's key message here is to challenge the status quo and embark on a journey to save substantial amounts of money while accelerating the repayment of your mortgage. He advocates employing two essential strategies: lowering your interest rate and making additional repayments. Let's illustrate this with an excellent example that demonstrates how you can save well over $70,000 and slash almost 7 years off your mortgage term by adhering to 3 straightforward rules. Rule 1. Keep it simple. A home loan is a straightforward arrangement. You borrow money from the bank and repay it, along with interest, over the next 25 to 30 years. Resist the allure of add-ons that lenders may offer in your home loan package. Stick to simplicity and steer clear of options like fixing a portion of your loan or opting for repayment holidays. Rule 2. Avoid fixed interest rates. Make a personal commitment to opt for the lowest variable interest rate you can find, regardless of what you may hear from others. Pape cautions against falling for the fixed rate trap, where a friend might boast about securing a fixed rate lower than the prevailing variable rate. Banks promote these fantastic deals because, with the government's ban on exit fees, they needed alternative ways to discourage customers from switching to better deals. Committing to a fixed-rate loan gives banks the upper hand, and if you ever wish to leave or refinance, you'll face a hefty, break-free cost. Rule 3. Secure the best possible rate. Pape recommends it's often more effective to negotiate with your current bank about interest rates rather than switching to a new one, and we concur. Replacing a customer costs a bank roughly $1,000 in marketing expenses, and it's even more costly if you approach them through a mortgage broker, who receives kickbacks. In his book, Pape provides specific guidance on scripting your phone call to your bank, a tactic that can save you $22,000 on a $400,000 mortgage over 18 years at a 4% interest rate. Give your bank a call and express your intent to refinance with another institution, such as UBank or ING, unless they reduce their rate. Be resolute, and if they refuse, stand by your word and switch banks, or try again another day. If they still decline, and you have more than 20% equity in your home, to avoid lender's mortgage insurance if you change lenders, bid farewell and secure a lower interest rate elsewhere. Alternatively, reach out to us regarding our mortgage brokering services, and we'll assist you in obtaining a better rate. Now let's move on to the second part: making additional payments towards your home loan. If you've been diligently following these steps, you should have funds in your fire extinguisher account. With its assistance, if you can manage to allocate an extra $1,000 per month on top of your minimum repayments, in conjunction with securing a lower interest rate, you'll save approximately $77,000 in interest and trim almost 7 years off your mortgage term, based on a $400,000 mortgage over 18 years. In Step 8, Nail Your Retirement, Scott Pape advocates the Donald Bradman Retirement Strategy. His premise is that you don't necessarily need $1 million stashed away in your superannuation fund to retire comfortably. Instead, there are specific financial milestones to aim for. Here's a breakdown. Rule 1. Eliminate your mortgage. This strategy only thrives when you enter retirement without the burden of mortgage debt. The age pension doesn't factor in the value of your family home, so it's crucial to ensure your mortgage is completely paid off before you retire. Rule 2. Achieve your retirement number. As previously mentioned, you should not consider retirement until you've reached a minimum of $170,000 in your super fund if you're single, or $250,000 if you're a couple. These figures represent the maximum allowable balance to still qualify for the full pension, which amounts to $34,252.40 per year for couples and $22,721.40 for singles. Additionally, you can withdraw $12,500 annually from your superannuation tax-free. This money can be wisely invested, as further explained in Pape's book, potentially resulting in an income of nearly $60,000 per year. Rule 3. Never fully retire. Scott Pape suggests that full retirement might not be the best path. He himself anticipates working until the age of 95. He recommends working at least 1 day a week or engaging in part-time work like Uber driving to stay active and supplement your income. The government permits retirees to earn $28,974 each year tax-free, and for singles, the limit is $32,279. To sum up your financial position, your home is mortgage-free. You receive the aged pension, which amounts to $34,252.40 per couple or $22,721.40 per single, plus $12,500 from your superannuation. You and your partner are generating $20,000 tax-free. This adds up to an annual income of $66,752, surpassing the requirements for a comfortable retirement by $8,000. While this strategy provides a solid framework, it's essential to remember that retirement planning should be tailored to your unique circumstances. If this approach aligns with your goals, we recommend seeking financial planning services to ensure it's the right fit for you. If you've diligently followed each of the steps we've outlined, congratulations! You're well on your way to achieving financial freedom. But as you journey towards financial stability, have you ever considered the lasting impact you could leave on the world? In this final step, Scott Pape urges you to contemplate the positive difference you can make in the lives of others now that you're in a financially secure position. It's a moment to reflect on the possibility of giving back, both in terms of your resources and your time, to those who are less fortunate. Perhaps you could explore the option of providing microloans to some of the world's most disadvantaged entrepreneurs. This is a time to define what you believe in and how you can contribute to your community and the world. And there you have it. You've successfully completed all 9 of the Barefoot Investor's essential steps. We trust that this summary has provided you with valuable insights into the path to financial well-being, making it feel more attainable and manageable than ever before. Let us recap all the 9 steps again. 1. Monthly date nights. 1. Set up your barefoot buckets. 2. Domino your debts. 3. Buy your home. 4. Supercharge your wealth. 5. Boost your mojo to 3 months. 6. Get the banker off your back. 7. Nail your retirement number. 8. Leave your legacy. That's all for today. Thank you for joining me for this review and summary of the book. If you want to listen to more audiobooks, please do not forget to click on like and subscribe to my channel. And if you have other books you'd like to talk about, feel free to tell me in the comments below. See you in my next audiobook.